It is April 25th. It's a Thursday, and I still got some allergies, so I'm gonna have to get used to that for a while. So my voice is gonna sound a little bit weird, but anyway, today what I want to talk about is why everybody's wrong about the market all the time. So first, we're gonna see what's going on in the account. We're gonna go into the browser right here, and um, there's some moves that have been taking place. So first off, it's Apple has been gaining a little bit. I have a call sold against Apple at 212.5, and right now I'm losing on it, but it's returned $50 today because Apple is down $97. And the call expires on the 3rd of May, which is approaching fast. So we'll see how Apple develops until that date. We have EXK. I actually bought EXK at 210. So I mentioned that I was looking to scale back into EXK because I thought it's reaching undervalued territory. So I did buy 200 shares to start off at 210. It went up yesterday. And now it's back down to 215. It went up to 223. Now back down to 215, which is fine. If it drops down below, maybe to 205 or below $2, I'll start buying even more shares, try to build up a position. Right now I'm sitting at 600 shares after I purchased 200 a couple days ago. You can see it right here. EXK purchased at 210. I also had dividends coming in from EDF, the Emerging Markets Dividend Fund. There it is, the Endeavor buy. Here's the dividend. Wheaton Precious Metals also gave me $10 dividend, which is great. The Emerging Market Fund actually is going up $135 today. It's quite a bit. It's like over 4%. Yeah, 4.63%. It's a pretty big gainer. It's generally a loser, this fund, but it gives such a fat dividend that it makes up for it. So we'll see how it goes. Let's see if, yeah, I see $41 dividend every month. I wouldn't necessarily dive into that fund though, because if it can't meet its obligations, I think it cuts off some of the top off of the principal, if I remember correctly. So you make sure you read the prospectuses, guys, whenever you're investing. That's always a good idea. The C-SPAN is down $85, and it doesn't hurt me that much because I have 2 calls sold against all of my shares, or actually 200 out of the 290 shares. So if you see, even though I'm down $84 on that position, I'm up actually 34 in the options play, so it makes up for it a little bit. If it drops down below $10, it's still not going to be a loss because of the calls. What else is going on in the account? We got Wheaton Precious Metals down $30. I don't have a call sold against it. I've been trying to sell calls against it for many times now, but there's just not enough liquidity. I just can't do it. Just can't do it. Okay, and we're left with the uranium sector, which is fairly flat right now, at least the shares that I'm holding. Chemical is down $53. I guess it's more not impressive, but it's kind of makes more sense to give it to you in the dollar amounts, because it gives you an idea of how much of it I own. Because if I just show you percentages, it's like, all right, well, 10% down on a $100 position is just gonna be $10. So not really very painful. But this way you can see the pain or the gain. It's more kind of a real feeling. Okay, so that's about it with the account. Nothing else really special. I'm losing $200 in the day. The options are kind of saving my ass a little bit. Otherwise, I'd be down even more. Even though the options were working against me yesterday. It's kind of like a neutralizer, I guess, if you will. The markets are fairly flat today. Let's look at SH. Yeah, markets are fairly flat. So I'm kind of losing to the markets, which is not a good feeling, but hopefully I'll make it up on the upside. If you want to take a quick look at the account, this is what it looks like. The largest position is Apple, total return of 5,000. It might be selling this position if it reaches 212.5, by May 3rd. So we'll see. That it won't appear like this anymore. Obviously, I've sold some gainers and losers, so this is not the full picture, but it's what the account looks like. Total return: C-SPAN's the second, wheat and precious metals third, energy fuels fourth, royalty income, so forth. The biggest positions are Apple, and then the Uranium fund, and the emerging market fund, and then RSX, etc. That's Russia. RSX is Russia. I've sold one call against Russia, so waiting to see what happens with that as well. Okay, that's the update on the account. So today, what I want to talk about is how everybody's always wrong about the market and why that is, and what I try to do about it. So the reason why everybody's wrong about the market is because when you have an idea, when you have a theory, when you have some kind of a trade idea, even if it's not yours, especially if it's not yours, it's always priced into the market, right? We talked about one time where everything is always priced into the market. So if you have that idea, you've most likely already acted on it. Like before I present these ideas on the internet, I've already done it, unless I'm doing it live, right? I've already done whatever I'm going to do. And that counts for everybody else out there. Every trader, every investor, every money manager, every big shot, not just small time investors. So everything is already priced in. Your idea is so the market, the only way it can perform is from a surprise, right? From a sideways move. Market always hits you from somewhere where you don't expect it. All right. So even big market predictors, and economists and managers and so forth, they have a theory, they have a theme. What is it called? Not an opinion, but well, I forget the word. Anyway, they have some kind of idea of how the market's going to go. It never plays out exactly the way they think. And that's why many of them have multiple positions, multiple ideas, not just one, because often just a few of them work out. Or even if it's the majority, they have to make money on some of them and lose money on some. So, and the reason is, like I mentioned, it's already priced in because they've already put the money out there, right? Like they've voted in a sense in the market with their current position. And so that way, whenever they're predicting something, people who come in fresh into the market are dictating basically the direction of the market, the way it's going to be changing. All right. So let's say I'm a fund manager, you're a fund manager, and we've already placed our trades, right? And we're just sitting. Somebody with fresh cash coming into the market has a fresh look and doesn't care about our biases, right? They're coming in with their own little theory that hasn't yet been explored, and that theory now gets acted on, and the act of buying or selling into that theory is now making it realized as well, and that's how the market moves. So now all of a sudden, even their theory, the newcomer, becomes realized. So basically, our our job is to figure out what hasn't yet been done, right? And even if someone just picks one stock and they're bullish on that stock because for whatever reason, they might be right, even in the very long term, but it's usually not for the reasons they think. Like something always hits them out of sideways, like let's say you're bullish on oil or you're bearish on oil because there's so many reserves out there, and you go and count all the reserves and you have a really well thought out theory of why the reserves of oil are so much and why it's oversupplied and why the price is going to go down and the demand is weakening, and you have all this picture perfectly figured out, and then all of a sudden, some kind of incident happens in the Middle East or whatever, and OPEC like starts cutting supply, or some kind of pipeline gets frozen in the oil market, and now you're stuck with your oversupply theory, but yet the price of oil is going up, right? So there's all kinds of factors that you aren't predicting. If you're going to be a long-term investor, maybe the low um, supply, I'm sorry, the oversupply of oil encourages people to buy more oil-burning cars instead of switching to electrics or hybrids, right? So all these shifts, there can be a million shifts. I'm just giving two examples, but there really can be, countless amounts of moves out there on the economic picture that you can't necessarily predict. And those are the ones that usually end up playing out because the ones you already predicted are priced into the market. So that's what I'm trying to say. So what I'm trying to do really is I'm trying to figure out. I listen to a lot of economic podcasts and news, and people talk about the market all the time and their views and their theories, even on a micro scale about specific companies. And I'm trying to get a big picture of what people are thinking, especially the ones that hold a lot of money, especially people that follow them, right? And trying to sum up all these opinions, especially even the counteracting ones and the ones that they think alike. And I'm trying to actually do the opposite of what they're doing as a sum. So whether it be Jimmy Rogers or like Peter Schiff or Dalio or I don't know, name any big investor, Warren Buffett. Okay, what was that guy that was bearish recently? There was a big bond manager. Oh, I forget his name. They named him the new bond king. I forget, but he was very bearish in the market, and he thought that this correction, right, that we're experiencing right now. Let's go in the browser. I'll show you. So let's go to the market SH. I'm blind. Oh, there it is. Actually, let's go to the SPY. SPY. So he thought, I might remember his name by the end of the episode here. He thought that this correction that we're having from here, from December 24th, that all these people, when they reach a level where they have bought previously, like in October or even earlier, right here, November 7th or so, he thought that they're gonna turn into sellers, right? Because it's a common trader behavior to wanna break even and cut your losses, right? Even sell a little bit before that level reaches. But as we can see over here, this bull market didn't really stop. It only dipped for a second and then it went aggressively higher. People were forced to chase returns from money managers and stuff like that. People that have sold on the downside here now having to buy up here. And so it ends up pushing the stock market higher and higher. So he controls a lot of money, but he was wrong on this, at least this far. And now if enough people are starting to turn bullish, enough people are starting to believe this rally, then it's actually time to go against that, right? Do you see what I mean? So you always got to try to go against what the masses are doing, and that's very simple, and everyone says that, but you have to include the people that are saying that, people that are contrarian. So if there's still enough people that are contrarian, they'll be like, oh yeah, bet against this because everybody thinks it's bullish, and there's a ton of those people out there that's saying that. Then you have to factor those people in as well, and that means the market's going to keep pushing higher. So if there's still enough skepticism, some people call it the wall of worry. So if there's still enough skepticism out there about the market that it's going to go, a lot of people thinking it's going to go lower and then it's just too high. The fundamentals are not justifying the move, or technically there's some reason why the market's going to be breaking down. And so as a sum, if you have enough of those people, that probably means the market's going to keep going higher. And if some of those people are starting to throw in the towel, or they're turning positive for whatever reason, then maybe other people going bearish. But whatever it is, that's exactly the time that you should be going against the consensus of those people that used to be bearish, okay, and actually going short with some of your portfolio, not all of it. I never trade more than 100%, more than 50% bearish, for a reason I talked about in a different episode. So anyway, that's all I had to say for today. everybody's always wrong about the market, including you and me, especially if we've already acted on it. So it's a matter of positioning against that, mass influence on the market. All right. I think I'll end it right there for now. It was kind of hard to get all this out in one try. I probably should organize it and say it again, but I don't really gonna get the time to construct the video like that. It's just a episode to kind of log into my progress and just spit some of my thoughts out. So no redos, one take. That's it. All right. I think that's it for now. Peace out.